Once again, we went to the streets of Central Oregon and found a great diverse group of people to interview on a nice fall day. Here's a look at what the folks had to say down on Wall Street.
The way I've invested and my lifestyle, it hasn't affected me at all.
Okay.
I don't expect it to either.
So you're probably more on the conservative side at
Yes.
this point in terms of the cycle of investing?
Yes. I study the market every day, and when it looks like things are going downhill, I pull it out and put it in a money market fund. Can't
Okay, so
lose
you're-
that way.
Right now I'm staying status quo, but
Okay.
I'm in other investments and I'm not actively managing my stuff.
Okay.
I'm in it long term, so I'm going to take the downs and the ups and
Just diversify the portfolio a little bit, so you have
Okay.
some options, and then it's common
The
sense.
currency
really.
market is the biggest.
It's the biggest market
Biggest
in the world.
market.
Absolutely.
Every day more transactions than what the New York Stock Exchange does in the whole year.
There's definitely change in there, but I think you've got to always look long term, because if anybody reacts to short-term movement in the market, they're always going to be reacting. And to be financially sound, you always want to be proactive. And so if you're confident in the long-term future of an area, be it real estate, stocks, bonds, whatever, it's really an opportunity right now to make some serious money. And if you're buying real estate, tremendous opportunity to pick up houses that will be more expensive in the future.
Okay.
I guarantee that.
As you can see from the responses we received from Wall Street on the people we interviewed last week, we had a very diverse group of people and answers to the questions we had to how do you deal with volatility in your portfolio that you're managing, either yourself or through your broker. And we got a very diverse group. And I guess I'll throw out to you guys again, why is it we got so many answers, and what is it you should be looking at as an independent investor when you're evaluating your own situation?
Well, I'll take it if you want.
Go for it, Dave.
I would say that it's probably a couple things. I think it's maybe a lot of investors, and they said this right before we asked the question, like, I don't really know much about investing. We're like, that's okay. That's kind of what we're after. I think some of it may have to do with, maybe people don't really know what to do.
And it's perceived as scary to a lot of people.
Yeah, exactly. And, I think once you start looking at investing, it's not overly complex, but it is intimidating to some people. And I think the other reason, I know Jesse's going to probably touch upon this, is that everybody has different needs. So based on your needs, your diversification is going to be different than his or the next person's.
Not just needs. Everybody has different needs, but everybody also has a different comfort level. Some people can be 80 years old and speculating in penny stocks, and that's their thing. So everybody has a different comfort level. I think everybody also has a different definition of diversified, or my portfolio is safe. My portfolio can handle what's going on.
Right.
So I think diversification is overrated. Personally, I think that first of all, if I'm going to diversify away from cash, I need to have a compelling reason. It's the only way I'm going to invest in something besides totally safe cash. And then I think you can over-diversify your portfolio into total mediocrity very easily. Like you own 3 mutual funds, and that's way too much, because you're going to own 1,000 some stocks. And that's overkill in my mind. For typically, I think you own, if you know what you own and why you own it, and you own 10 different stocks and a couple of, you have some money in your house, whatever, you're probably well enough diversified, in my opinion.
And if you're just coming out of medical school and you have to pay back debt from the last 8, 12 years, that's an investment that you made in yourself and in your education, and paying that off is going to be maybe one of your primary goals before you start saving for your children's education. But you've got a lot of concurrent cross currents going on, depending on where you are and what stages of your life. Whether you're just coming out of college, just finishing grad school, just starting a family, trying to buy your first home. These are things that you're saving for. Retirement becomes an issue, but maybe not until you're making enough money to save for the retirement. And then you've got, again, children's education, with education costing $40,000 a year. I mean, it's spooky. And if you start thinking about numbers, and these are just average numbers, no wonder people just shut it down.
Sure. But I think at the same time, the standard rule of if you're in your 30s or so, or you're in your 20s or 40s, you should have 60 to 70% in stocks and the rest in bonds. I think that's a little bit too simplistic of a view. The markets are too fluid. Granted, they're fluid on a short-term basis, but even on a month-to-month, year-to-year basis, I think there always has to be a point, a few times a year or whatever, again, goes back to your needs or your desires from the market. got to reevaluate your portfolio.
Well,
what's working, what's not
Well,
working.
and there's going to be the guy who says, I got all my money under the mattress, so I'm going to diversify and put some under my son's mattress, under the,
Right.
whatever, that's his thing.
But everything
need
you
to
own
reevaluate.
has a time frame. It could be. I mean, if you're trading something, if you're trading the Canadian dollar, I mean, you have a time frame going into that, and you have a goal. You should have an objective when you get into any idea. Being opportunistic on any time frame, you need to define. Well, how much am I willing to risk? It still comes back to this: define your risk first, then define when am I going to start taking profits on my.
That's
on
a
my
good
objectives.
point to add to our know what you own, know why you own it, and how long you want to own it for.
Right.
Those are the three things.
Or more importantly, maybe you want to own it for the next year or so based on what you've done in terms of your research, but 6 months later,
your objective's hit?
Maybe either your objective was hit, or maybe maybe there was an election in that country and the political process has shifted. Well, suddenly that investment may not be attractive anymore, or maybe it's even more attractive.
Right, exactly.
One of the things I remember an old family friend saying was, "I never sell stocks that I own." And as a young kid, I didn't know any different. But now looking at that, it's like, well, companies always morph. They become good companies, then they become bad companies. You just never know.
Yeah, if you had owned Enron for a long time, you made a lot of money. But if you said, I'm never going to sell it, you lost it all.
Right.
So you can't always think that way.
Mm-hmm.
Exactly.
We need to take another break, but when we come back, we'll finish with our fantasy finance segment, where we're going to make picks, cover our picks from last month, and recap what we've been doing lately.